So we're good to go.
I would have thrown a wig on too, man, if I was doing any kind of makeup work here. You know,
I don't know.
Got to cover up this crazy.
The wig
hair
needs
that
to
I got
latch
going
onto
on.
something, man.
That's true. That's true.
But welcome to Money Mondays.
Yeah.
We do this every Monday at what time, Ben?
3:30 Central.
3:30 Central. So
yeah.
for those of you tuning in for the first time, we talk about a lot of different topics, right? This week's topic is
The ins and outs of passive investing.
real estate investing.
Oh, that's a real estate.
Geez, you missed like two of the 8 words in the title,
all right.
man. 25% off. But,
Okay.
you know, we do all sorts of different topics. This week we're talking about passive investing in real estate. But, you know, if anyone has any future topics, please let us know. We're happy to go through topics. Yeah. You know, we really try to go through these and kind of talk about what we know, what we don't know maybe, right? And kind of share the things that we know and don't know. But more importantly, at the end of this, we do Q&A. So we were happy to kind of solicit live feedback. So if any of you have any feedback, please feel free to ask.
Yeah, we want it to be interactive, right? You know, I mean, so yeah, definitely encourage people to let us know if they've got, you know, some topics that they want us to cover,
absolutely.
right?
Is your haircut interactive?
It can be. I was gonna ask you know on camera today. Hey, anybody know a barber that'll come out to the house?
Can add it as a benefit for the team. You know, a company benefit. We can get a masseuse, get a haircutter, and.
Well, no, it's unfortunate because of COVID. You know, the barber that I was going to, had to come out of business, man.
We did get a fish tank for the office. That's a new addition, right? So the team is growing.
It was by 3 fish.
Saltwater fish tanks.
No, and it was as heavy as it sounds, folks. You know, but it looks beautiful. We always want people to kind of come over, so it's another talking piece for us.
Absolutely.
So, all right, well, let's hop back into this, right?
Let's get going.
Let's talk about some real estate here. So, getting started as a passive investor, what are the first steps? You did a little bit more passive investing than I did. You know, so why don't you kind of talk through what your process kind of looked like?
I mean,
right?
to me, I think the first thing I'm just going to say, getting educated, right? Regardless of what you're investing in. I know we're talking about real estate, but whether you're doing real estate or oil, you know, go get educated. Go learn from people that have done it. Usually, I like books. Podcasts is obviously a new thing as well. For me, I learned most of what I know from podcasts and books. I mean, hands down, no questions asked. Get educated, figure it out, but also hop in and get going, right? Go to meetups, meet people that are doing it, right? That's the big thing. Get a little bit of guidance, but also don't sit on the sideline and don't expect a home run on your first investment, right? I mean, it happens great, but also it's about learning through the process and, you know, kind of get going. So,
and we've got a good module on investoracademy.net, folks. You know, if you want to check it out, it's one of our cost-effective, you know, courses that we have online, and it really goes A to Z. You know, it's a 30-minute show on Facebook Live and on some of the other platforms that we have, you know, stuff on. So we can't dive into all the intricacies of it, but you know that kind of has a lot deeper dive on investoracademy.net, right? So, you know, getting educated is one big step, right? You know, networking with the right people. You know, even as a passive investor, there is a little bit of a job, you know, because these are such tight-knit investments, right? You got 20, 30, maybe 40 investors on the whole thing. You got to be at the right place at the right time, right? And you have to know those people that are doing deals. You know, you can't generally solicit these for the most part, right? Now there's 506Cs and Bs, right? So maybe you'll stumble across some of those, you know, but for the most part, it's 506Bs, right? And so those mean that you have to know the sponsor ahead of time, you know, and be on their distribution list to even be able to look at the deal. Right? So you have to get out, you have to pass out some business cards, especially at the beginning, and really kind of understand who's doing deals. All right. So that's kind of going to our second question, which is, you know, how to find deals. Well, you got to get out there.
Get out there, talk to people, the term you're looking for, figure out what you want to do first, right? If you're purely I guess one thing we kind of glossed over. If you want to be purely passive or quasi-active, quasi-passive, or fully, you know, you're participating 100%, but you're kind of thinking it's passive, but it's not really passive, right?
Well, let's take a step even farther back, right? We dove right into passive investing. Some people might be like, what the heck is that? Right? Let's go
through the tiers of passive. Let's just maybe go up the echelon. So the first thing you have is pure passive investing. To me, that is, I'm going to hand Ben some money. I'm going to check out, right? You know, meaning step away, trust him to do his job, right? And he is going to hopefully get a return on my money, right? I'm not very involved. It's very passive for me. I may be filling out some paperwork. I may be doing some wire, and I'm getting mailbox money, right? The next rung up usually is people that want to figure out how to get involved in a deal, right? So maybe Ben is buying a deal and I partner, hey Ben, can we partner? I will help you with X. I will help you with the construction management because I live in that city and my background is in construction, right? So now I'm probably investing money, which is going to generate some income, but I'm fairly active, right? The next rung up is like, hey Ben, I want to do what you do, right? I'm going to be you, right? So now again, usually you're investing money, but it's very active. And then last but not least, some people buy their own deal as well, right? And that's kind of going up the ladder. It's not really just passive investing at that point in time. To me, that's all active.
And you can do it any combination. I mean, it doesn't mean we've seen a lot of people take that rung upwards, but we've also seen people that have just dove right in, right?
Yeah. And as Chat said, hey Chat, how's it going?
Hey,
he said it's all about your goals and how much involvement you want to be in a deal. That's
true.
Exactly
That's
right.
True.
So there's pros and cons of each level, and it's all about your time. We find it what you're looking to get. Are you trying to convert sweat equity into equity? Or are you retired and looking for cash flow? I mean, it just depends. Everyone's got their different things, and there's not a right or wrong.
And I've always tell people, with our deals, and I'm sure it's probably similar to some of the other folks' deals too, right? You got to fill out 4 pieces of paper for us. You got to make a wire transfer. And then all we ask after that is that you review the monthly financials, you ask questions, right? And most people don't do that, but we still ask people to do that, right? And beyond that, right? It's not even mailbox money anymore, right? We don't do that because it's too labor intensive. We're just getting dumped at ACH into somebody's account, right? So then you kind of sit back and you let the distributions kind of come in. But that's really, as a passive investor, that's all you have to do, right? I mean, beyond obviously you got to vet the sponsors,
you might have some voting rights later on, right?
Yeah, but I mean, even
read
that
your company agreement. Every company agreement is a little different.
Yeah, I mean, even that's a simple email, right? There's not like you're going to have to go somewhere and vote in person. I mean, obviously there's a little bit of there has to be a quorum and a certain amount of people have to vote yes to do something. But review your company agreement just to kind of see if there might be some additional things that you have to take into consideration whenever you invest. But for the most part, it's very minimal. So that is what passive investing is in the most truest sense. And for a lot of the working professionals that we work with, this is the best option for them because they're working 40, 50, 60 hours a week and they don't want to do what we do. We live and breathe this stuff every single day, and so for them, it's the perfect combination, right? They get the benefits of investing in commercial real estate without the headache, of actually having to manage the asset, right?
Absolutely.
So kind of moving along here, because I know we kind of got a little
sidetracked. Ben tends to get sidetracked, but it's okay. We like to talk, that's what we do. So, you should see us in our conference room. We'll go through 40 different topics around the world and be back and start over where we started. So.
Hey, we try to get some stuff done. It just depends on how much coffee we've got. All right, so let's talk about what is the typical minimum investment for multifamily syndications.
Sorry, before we go with that, going back to the find deals, maybe we talked a little bit about where to find sponsors, but maybe you want to touch on things to vet. How do you vet a sponsor?
Well, I think that's important. I think we got that. Something's coming up, right? No. Okay, so let's talk about that. That is actually important, right? From a perspective of what are you looking for in terms of a deal? What are you looking for in terms of a sponsorship team? Right, you need to define your box right first. Where do you want to invest?
This is your box, not the
this is not my box. This is like, hey, where do I want to invest? Right, so you want to say, I only want to invest in Class A deals in primary markets, right? And that means DFW, Houston, Austin, Atlanta. Those are primary markets, and you're only going to invest in the newer assets. Say 90s and above is going to be Class A, right? That is your box. That's a pretty defined box, right? And so you're only going to look at deals that are falling in that box, right? And then from there, right, okay, now I found a deal, it falls in this box. Now what do I do? Now I'm going to vet the sponsor, right? I want to make sure that their track record is there. They've got, the business acumen to pull it off. They've got the team to pull it off, right? They maybe got assets in that area, or if they don't, do they got boots on the ground? You need to go through some vetting process. You need to ask questions.
And sorry, go ahead.
I was always going to say, I'm always leery, unless people have invested with us prior, I'm always leery of anybody that doesn't ask questions and just willy-nilly invest into our deal. Yeah. And I usually will call them up and say, hey, did you review the company agreement? Did you review the PPM? Did you go over the webinar that we went through? Because what we do is we go through a webinar, it's usually an hour and a half. We go through the whole entire business plan and we let people ask questions and try to pick it apart at the end, right? It's an open Q&A. We don't hold back. We've also gotten some crazy questions, but that's fine. We want people to put us on the hot seat. This is their hard-earned retirement money. So you have to ask questions, folks, but that's the one thing. You have to define your box, make sure, hey, this is what I want to invest in, and then from there you find those people that are doing those types of deals, and then you vet them, right? And it's a typical thing. If you're going to be a partner with somebody, which you really are, you need to vet somebody, right? And asking those tough questions. There's nothing if your sponsor is not answering those, I'd be leery.
Yeah, absolutely. Yeah, don't be scared to ask them what their best deal is, what their worst deal is. Yeah. Why is it the worst deal?
What's happening with them?
Have they made exits? What have those exits gotten, right? Can I talk to your investors, right? Yeah. So you should. I mean, this is your hard-earned money. Don't be scared to ask your sponsors questions.
And folks, there's always people that are starting off, so everybody always has to have that first deal. So, it can either be a disaster or it can be wildly successful, right? But you need to determine, okay, who is that person's first deal? Who are they partnering with? Because I think on that, it's not necessarily going to be that person that might have brought you the deal, but more so the team's experience too. So don't just vet and look at the one guy or gal that's kind of leading it. Look at the team. Because there might be 2 or 3 guys or gals that are in the background that are really the ones that are kind of shepherding the deal along too, right?
Yeah, so for those of you tuning in, Money Mondays, we do this every Monday, 3:30 Central. Talk about a big variety of topics, usually real estate focused, usually multifamily focused, but we're happy to talk about any topic people want to talk about. So if you have suggestions, please feel free to let us know. Otherwise, we're just going to keep picking topics out of a hat until we run out of topics. So that's what we're going to do. So
our hat's going to continue to get bigger, though.
Yeah.
It's got to keep picking things out.
Ben's got a lot of hats. Ben likes to wear his hats.
I got to cover up his head.
Yeah. Now, if only he could use those hats while he's working. So, anyways, more importantly, so this week we're talking about the ins and outs of passive real estate investing. Yep. Right. We're going to wrap up this presentation probably in about 5 minutes or so. So if you have questions, to me the best part is Q&A. That's what we enjoy the most. That's what I think the audience gets the most out of. So feel free to leave comments, questions. We'll talk to them. So really quickly before you do that, chat says vetting your sponsor is one of the most important aspects of my decision making and joining a team. Mm-hmm. It can make or break a deal for me. Absolutely. No questions asked.
As it should.
It's not just about the deal, because a good sponsor can make a mediocre deal, maybe perform, right, if they think it's going to perform.
Absolutely.
But a bad sponsor can make a good deal terrible.
It goes both ways, right? A great deal can be mismanaged and a bad deal can be brought across the finish line, right?
Yeah. And Iggy says, what's up?
Hey, what's up, buddy?
How's it going, Iggy? Amanda says, I always recommend speaking to people who have invested with the sponsors in previous deals.
Yeah,
totally
absolutely.
Agree. No. Ronnie says, what's up, guys? Both of y'all have Starbucks today. Time for y'all to co-GP a Starbucks deal. We want to buy a Starbucks property so we can rent it, just so I could say I own a Starbucks.
I bet you the cap rate on that thing is really low. It's probably like a 3 cap.
Yeah, I wouldn't be surprised. But we're not wearing plaid today, so we're both wearing blue, sporting the blues.
I really thought about it this morning, but I decided that.
Leslie Chat says, try and spend time with sponsors and ask questions, verify on your own. Trust but verify their track records, integrity, skills, values, and goals be aligned with yours. Completely agree. Yeah. Go to their office, go see their fish tank, go hang out with them, go see, definitely.
No, you need to feel comfortable with these people, right? It's not just yes, you can never meet them in person, but you need to have some phone calls with them. You do need to do some background checks. You need to understand where they're coming from and where they've been, right? Because it is important. And I think integrity, chat brought stuff like that up too. Some of these soft skills are important, right?
Yep.
Are they going to do the right thing? You are wiring somebody money, folks. You need to trust that they're going to not take off with your money, right? And so it's very, very important that you trust these people and that they're the highest integrity, right? So talking about some of these additional questions here. So I'm gonna hop around because we're kind of running a little bit behind on time, right? What is the typical minimum investment? We've seen anywhere from $25,000 for a passive investment upwards. I think the most that we've seen is probably $500,000. To kind of get into some of these, more institutional, funds. But assume that what you're going to see from us is going to be anywhere from $50,000 to $100,000 minimum, right? Friends and family, we might, work in the deal. It's really up to our discretion. Yeah, the reason that we try to keep it at a certain thing is that we don't want 200 investors on our deals, right? That's a lot of paperwork. That's a lot of compliance. That's a lot of tax returns that we have to do. So we usually back into what the minimum is going to be, and that's the reason why we pick different amounts. Yep. And also just depending on how big the deal is. So that's one of the questions that we had.
Yeah,
So
and
let's
usually
talk
you'll
about-
see it between 50 to 200,000, the kind of the spread that I see.
Well, no. I mean, I said 250. I mean, I've seen upwards of 500K, right? You got to be listening to me, man. Come on, you're killing
Fine.
me.
I'm
You're
kind
killing
of
me.
spacing out. I'm here texting with my friends. All right.
Well, somebody's
for
gotta do
any-
some work
so
here,
any of
right?
those people, if anyone,
Somebody's
so
gotta do some work.
those of you tuning in, Mondays 3:30 Central. Go ahead and leave comments, questions. We're about to go open up the Q&A.
Yeah.
Talk about a lot of different topics. This week we're talking about passive real estate investing.
All right, so let's talk about top underwriting metrics. I think some of the things that you probably want to focus on: is it a good deal or not, right? And this is all very, don't take this as set in stone. Or I think each metric is important in its own way, right? I usually look at stuff as an average annualized return, right? Because if I can get 6 to 8 in the market, and the market being the stock market, right? If I can get 15 to 20% in a multifamily deal and get the tax benefits of investing in commercial real estate, I'll take that deal all day long, right? Now, does that include, is the majority of that average annualized return in cash flow, or is the majority of that on an exit? And so you have to kind of weigh that too, right? So a lot of people will talk about cash on cash returns, total returns, but what average annualized returns is, folks, is you take the total return that you're gonna get, say it's 100%, right? And say you've owned the property for 5 years. Well, what's your average annualized return? 20%, right? So
Well,
that's what it is.
Because I was too
That was
busy
a
messaging.
tough one. That was a tough one. But I like that because I look at things in that way. But other folks are IRR driven, guys
to
and
me
gals.
though, I would say honestly, take the top underwriting metrics. First thing I like to look at is what is the reversion cap that person's going to use.
No, I was getting around
What
to
is
that. That's
someone
important.
going to value the exit value?
Yeah.
How are they going to value what the property is worth at the end?
Yeah.
Because that's an easy number to tweak, and all of a sudden a bad deal looks great.
Yeah, and so you have to be, one thing, we won't get too far in the weeds, and we talk about this on investoracademy.net, folks, is, a reversion cap is obviously the cap rate that you're gonna value the property when you go to sell. And usually the rule of thumb is, okay, so say we bought it at a 6 cap, and we've held it for 5 years, and we're gonna say that, hey, we're gonna increase that reversion cap rate 10 basis points for every year that we hold it, right? So now we're gonna sell it at a 6.5 cap reversion, right? We've seen people go the opposite way, right? Where they're actually decreasing their reversion cap rate to a 5.5. And then they try to justify it, oh, the market's great, or it's gonna get better, or interest rates are gonna be low, and blah, blah, blah. It's always better to err on the side of caution and say, hey, if we get better than this, great, but this is what I'm saying that we're going to sell it for in 5 to 7 years. Because ultimately nobody has a crystal ball. So that's why it's better to be conservative than to try to be aggressive and try to make the deal work. So reversion cap rate's a huge metric that somebody should take into consideration, right?
Yep.
And ask those questions. Typical returns, right? What we project is anywhere from 8 to 12% cash on cash. And usually our total returns, on a 5 to 7 year basis, it's going to be a 2x multiple. So that means it's going to be 100% return or more, and that's what ultimately we're always trying to find deals that hit those boxes.
In most deals, any deal that you see is going to fit that box. They're all going to be in that, I'd say 7 to 11% average cash on cash.
Why you always have to go differently than
Yeah,
I said 8 to 12.
I'm saying just kind of, that's what ours, but I'm saying just kind of in general, like average, maybe our deals I think are a little bit better cash flow. But in general, deals that hit the market, that people position the way they position them, they're trying to position that 6, 7% up to 10, 11%, right?
Yeah.
Cash on cash. They try to position at 10 to 15% IRR. Now, it's ultimately, can they hit it? It's a different question. But in terms of what they're positioning,
Man,
right,
I would say,
the norm.
that's probably a good thing to kind of, so some rules of thumb that we always say is we're always trying to hit a 14 plus, maybe 14, 15 plus IRR, probably 15 plus AAR. And then like we talked about on the cash on cash returns, anywhere from, probably 8 to 12 is what you're kind of looking at, from us. And we invest in B and C assets. We're trying to do some nicer stuff. So, stand by, folks. Hopefully we have some good announcements here in the next couple of weeks. But, for right now, that's what you're going to see usually on a B and C asset. And in most primary markets, and it can fluctuate a little bit, but that's usually what you're looking for. So if somebody comes at you and says, oh, I got this 10% IRR deal in some secondary market, right? That is not a good deal.
No.
That's a deal that you should run away from because it's already risky because it's in a secondary market, and 10% IRR is below where it's supposed to be, in the industry.
Yeah.
So those are some typical returns. So We got one question in.
All right, before we do that, for those of you tuning in, Money Mondays, we do this every Monday, 3:30 Central.
Yep.
We talk about a bunch of different topics. We're talking about passive real estate investing this week. But if you have future ideas for topics, let us know. We will do a whole show about it. Otherwise, we'll keep picking topics, and we're in our Q&A section. So if anyone has any comments, questions, go ahead and leave them. This is the best part in my mind, hopefully the most value for you all.
All right, you want to
And
go with
kind
these
of going
and then we
through
can go to
really
this?
quickly. So Ramil says, hello.
Hey, guys.
Ronnie says, most institutional LPs are very IRR driven. I completely agree that they are. I don't know if I necessarily agree with that philosophy, though. I think cash flow is probably just as important. And chat says, exit cap rate, rent bumps, is it sustainable from their analysis?
Yeah, absolutely.
Absolutely. Because it's so easy to say that this potential, I'm going to go make this place look awesome and charge $1 million of rent for it. Well, is that sustainable?
No, and that's
Probably
actually a great example. Thank you, Chad, for pointing that out. I don't know, we're moving quick. So yeah, rent increases. We have seen people that they're going to put $3,000 in, which is really not a lot of money, folks, into these units, and they're going to charge an additional $200 a month. It just doesn't work like that, right? So you have to say, is this justifiable based on where the comps are? Yeah. What's the competition doing, right? And sometimes you'll see they'll have their comps in there, and the comp is way across town and is a 15-year newer asset than the one that they're buying, and you can pick that apart pretty easily. So, but that's a good metric to be on the lookout for as a passive investor. So, all right, so we got a question here: which multifamily asset class generates the best returns for passive investors? Man, we always get these tough questions. I mean, all right, so
the cash flowing one is my answer.
You want to go? Yeah, that's probably the most diplomatic way to say it, right? Which one provides the best returns?
Yeah, I mean they can all vary. It's all about the price you buy it at, the market you're in. It's not, the other thing I will say is that usually with like a seed value add, there is more risk with having to implement the business plan than buying a stabilized, what they call a coupon clipper, right? A coupon clipper is just a deal that is humming along, it's doing what it's doing.
It's
you're
just
not
a yield
really,
play, right? It's a little bit more turnkey. You don't have to do much, and you're just getting your 6 to 8%, right?
Yep.
But I would say that the days of finding those Class C value add properties, especially those ones that are going to be in B and A markets, those are long. Have long since passed. So you have to realize that anybody that's buying those value add plays nowadays, this is probably the second round of updates that have happened since the downturn in 8, 9, and 10, right? You probably have already had somebody come in and do a value add. So kind of looking at something that maybe is a little bit newer, might be a little bit less risky. I think we're more leaning towards weighing risk versus return, risk-adjusted returns, right, is what John Montero likes to say, and that's exactly where we've been probably the last 12 months is, which asset is going to provide the best one, right? Because like Ferris said, those Class C deals, if you get one of those diamonds in the rough, man, those are great. We have made a fortune on those, but they're just not there anymore. So maybe stepping up to a little bit better one will actually get you a little bit or just as good a return, and you get a 15, 20-year newer asset, which is less risk. So I know that's probably not what that person wanted to hear in terms of the answer, but that's going to be our answer on that one. So did we get anything else on Facebook?
No,
or what?
that's it so far. So if anyone has any questions, feel free to let me know. I mean, the one comment that we did have, actually, no, there's one that I saw Ronnie's, I didn't see Amanda's. So Amanda says, after you are in a deal, which KPIs should a passive investor monitor throughout the life cycle of the deal? Yeah. Are there any red flags that a passive should look out for?
I think absolutely. There's plenty, right? I think the easiest one is where are they at actuals versus projections, right? Or even more so, you could even do budget versus actuals. What you're getting in terms of your financials, which, we try to make sure that the budget matches the projections. Sometimes they're a little bit off, especially when you're using a third-party property management company that pretty much does whatever it wants. But that's probably the easiest way to track, like, where's the revenue at versus where it was supposed to be at, right? Or where are the expenses at versus where it was supposed to be.
And another one too is look at the balance sheet. I don't think enough people look at a balance sheet. I think that's a very critical thing to get an idea of what's going on a deal.
Yeah, and there might be a lot of that's the other thing too, right? There's probably a lot of cash that might be sitting in the bank.
Cash.
There's cash. There might be money tied up in escrow that could be part of the business plan that still needs to be executed too. right? So, but I mean, I'd say the easiest metric is just, what do you get, what'd you project versus what's happening right now? And there could be a good justification, right? I think the one challenge that we've had in the past, right, is the lender has dragged some of these draws out, and this stuff just takes longer than anybody anticipated. Now, don't get me wrong, we'd love to get in and get done with the rehab in 2 or 3 months. It just doesn't happen because the lender is always jerking us around.
Yeah.
So sometimes there could be a justification for, hey, why is it slower than what we anticipated, right?
Yeah.
But it's really the lender's fault.
So why don't the lenders like you?
I don't know, man.
I don't know, these lenders, man.
I bust their chops quite a bit. Because you're pushing, you want to push, but you can only push so much, right? They're the lender. You got to be somewhat,
They're your partner in the deal. So
yeah, you got to be somewhat, I guess, professional with them. But, the servicing side, which we won't get into the weeds on that, is just usually the people that approve and process draws, and they're usually the lowest rung on the lender pole.
Yep.
And so they can slow some stuff up. So bottom line is that there could be a justified response to that, but you just need to ask those questions. Ask questions.
So what should LP's net return criteria look like in today's market? Cash on cash, IRR, et cetera. Cash on cash, 7 to 12%, totally depends on the play. IRR, you're looking for 11 to 17%, right? If it's higher than that, you really question the underwriting, right? I mean, if it's lower than that, you got to understand the deal. And total return, you're looking for probably an annualized basis of about 15%. It's kind of what you're seeing, right? Somewhere with that 13 to 20% annualized. 20, it's kind of what I think.
Total return, yeah. I mean, then you just times that by the amount of, usually
and I
for
guess
us, it's 5 to 7 years. We're trying to have 100% total return.
It ties to the next question. What about hold times? 5 to 7 years.
Yes, there you go.
So Money Mondays, we do this every Monday, 3:30 Central. We talk about a bunch of different topics. We're talking about real estate, passive investing this week, but we're happy to talk about anything. We're in the Q&A section, so if people have Q&A, let us know.
I'm on.
Otherwise, we should keep going, actually.
Well, that's our last question, man.
We'll keep going. We got one more slide. Two more slides, actually. And if anyone has any questions, go ahead and leave them. We'll answer them. So,
all right, what do we got, man?
If anyone, free lessons about multifamily syndications versus REITs, go to disruptequity.com/syndication VS REITs, so VSREITS. Put together a package there around stuff you can access. And keep going. This next one's yours.
All right. It's probably going to be about what we're talking about next week. All right. Want a roadmap to passive investing real estate. All right. So so we're giving 30% off for our passive investing course, right? So this is what I was talking about earlier, folks. InvestorAcademy.net. Use the coupon code MoneyMondays $, right? And we've got the URL over there just to go straight to the actual thing. It's really cost effective, and we take an extremely deep dive on this stuff.
Yeah, for us, it's a way to educate investors. We get asked all the time about all this stuff. So we spent a lot of time, a lot of hot weekends in the studio putting together a nice show, kind of really doing deep dives.
We did. We hopefully added a lot of value here. I mean, we just opened up our kimono and just let everything out, and that's what InvestorAcademy.net is.
So we got another question. What about waterfall structures that LPs should look out for? I'd say clawbacks actually is one thing. Understand what those are, how those work, right? You see those more often, right? And what else am I missing? And then in the end of the day, understanding, like as an investor, so you want the sponsor to make money too. So it's okay if the sponsor is, getting rich on the upside. You already probably made your return, but just understanding where those thresholds are, what those look like, right? And what happens if the sponsor doesn't perform.
And I think we talked about this. Was it last week? Chris was bringing up some good points here. Ultimately, you just need to ask the question. Okay, so what if, half of what you say is true, right? Instead of making that $1 million, a year, you're making $500,000. Who gets paid? Right? Ask those questions of the sponsor, because we're seeing some more and more complicated, weird ways of putting deals together. And I'm not saying that they're bad or they're wrong. They're just different. And I'm a big proponent of it. If it's overly complicated, people don't like it because they feel like they're getting the short end of the stick. So if you still like the deal, you like the sponsorship team, but you just need to understand a little bit more, ask those questions. Just say, hey, give me 10 minutes. I want you to walk me through some scenarios of how much money I can make. And they should have those numbers. Right? So What's coming up next week, man? What are we
Next
talking
week,
about?
we're talking about how to raise capital during COVID-19. Not COVID-18, not COVID-20, COVID-19.
Well, we're hoping we don't have a COVID-20. Jeez. Yeah. So we're just going to please COVID-19.
So we'll do a deep dive on that. If anyone has any questions, you can go ahead and send them out to us, and we'll get them kind of ready for next week. Otherwise, we'll answer them Q&A live. So for those of you tuning in, Mondays, 3:30 Central every Monday.
Yep.
Every Monday, even Columbus Day. We continue to work hard.
I didn't know that it was a holiday until Lily and my daughter told me. She's like, I'm staying up because I was like, we're going to school. What's going on? She's like, oh, it's a holiday.
So hope to see you guys again next week. But, thank you guys. And if anyone has any more questions, we're going to wrap it up right on time. Well, actually 2 minutes late.
Oh,
going once.
Whoa.
Twice.
Well, there's always a little bit of a lag. So let's
2.2, 2.5. Right. We really want Dennis.
So we're going to talk about raising capital next week. So that's an interesting topic. A lot of people are interested in that. So why don't you tune in, send in your questions ahead of time. We'd love to take them. If not, I think we're good to go.
Yeah, we'll see.